Welcome to the Long and Short Forward Curve, an audio blog production by Eurizon SLJ Capital that distills our weekly insights and institutional research into clear, forward-looking views on policy, markets, and global capital flows, and has been written for professional investors. This is an audio version of a LinkedIn newsletter written by Matt Jones, published on the 17th of March, 2025. This week's FOMC meeting is widely expected to be a non-event in terms of immediate action. Markets aren't pricing a cut, and Powell is unlikely to deliver one. But that doesn't mean this meeting doesn't matter, because in 2025, the dots are doing the talking. In our latest episode of The Long and Short of the Week Ahead, I spoke with Eurizon SLJ Capital's Neil Staines about what matters for markets. His view was clear. The most important signal from the Fed won't be the Fed funds rate, it will be the updated economic projections, especially how the Fed balances tariffs, geopolitical risk, and equity market fragility in its inflation and growth outlook. The macro setup, complex, political, and volatile. As Neil pointed out, we're coming off a stretch where fiscal rhetoric and tariff threats have dominated price action. That's pushed markets into a wait-and-see mode. But a deeper macro conflict is brewing beneath the surface, between the market's expectations of fiscal expansion and the Trump 2.0 administration's stated commitment to consolidation. In the External Revenue Service, Tariffs and a Tobin Tax by Stephen Jen and Joanna Freire, Feb 7, 2025, we highlighted Trump's push for the ERS. President-elect Trump issued the following tweet: "I am today announcing that I will create the External Revenue Service to collect our tariffs. They will start paying, finally, their fair share." This isn't just a communication strategy, it's a fiscal worldview, one that replaces domestic taxation with tariffs and forces a rethink of how much fiscal support markets can count on. The real policy divergence, fiscal versus monetary. This week's FOMC projections may show more than just updated inflation and growth forecasts. They may reflect the Fed's attempt to adjust its reaction function to a world of geopolitical instability and fiscal ambiguity. In Fiscal R* by Stephen Jen and Fatih Yilmaz, Jan 21, 2025, we made a critical point. For the US, the Fiscal R* may be around -2.0% real and -4% nominal. A nominal interest rate of -4% is needed to hold the US's debt to GDP constant. That's a long way from the current stance. If the administration truly follows through on fiscal consolidation, taking the deficit toward 3% of GDP instead of the market's expected 7%, then monetary policy has more room to cut, and sooner. This week's dot plot will help us determine whether the Fed is starting to accept that possibility. Equities have already voted. Now it's the Fed's turn. The recent correction in US equities has already signaled rising concern around macro fragility and earnings compression. While the Fed may not respond to equity volatility per se, it will be forced to account for tightening financial conditions, especially if consumption data, like Monday's retail sales, shows further signs of slowing. As Neil noted in our podcast, expectations for action at the FOMC are very low, but the updated projections and the dots will be the main focus. Markets are no longer debating if policy needs to adjust. They're trying to determine who moves first and by how much. Watch the dot plot, not the rate decision. This week's takeaway won't come from the press release for institutional investors. It will come from the trajectory of the dots. Will 2025 cuts be pulled forward? Will the Fed mark down its growth estimates in light of trade disruption? Will the long-run neutral rate move? Each of these signals will shape the dollar, front-end yields, and equity volatility through Q2. And in the context of a still unfolding tariff regime and potential fiscal tightening, what the Fed chooses not to adjust may matter just as much. This newsletter is issued by Eurizon SLJ Capital Limited, ESLJ, a private limited company registered in England, company number 097755525, having its registered office at 90 Queen Street, London EC4N1SA, United Kingdom. ESLJ is authorised and regulated by the Financial Conduct Authority, FRN 736926. This newsletter is a marketing communication intended solely for professional investors in jurisdictions where the public offering of products or services is authorised and is provided only for information purposes. It has not been prepared in accordance with legal and regulatory requirements designed to promote the independence of investment research, and is not subject to any prohibition on dealing ahead of the dissemination of investment research. It does not constitute research on investment matters and should not be construed as containing any recommendation, advice, or suggestion, implicit or explicit, with respect to any investment strategy or financial instruments. The issuers of any financial instruments or a solicitation, offer, or financial promotion relating to any securities or investments. ESLJ and its affiliates do not assume any liability whatsoever for the contents of this newsletter and do not make any representation or warranty as to the accuracy or completeness of any information contained in this communication. Views are accurate as of the time of publication. Opinions expressed by individuals are their own and do not necessarily reflect those of ESLJ or any of its affiliates. The value of any investment may change, and an investor may not get back the original amount invested. Past performance is not an indicator of future performance. This communication may not be reproduced, redistributed, or copied in whole or in part for any purpose. It may not be distributed in any jurisdiction where its distribution may be restricted by law, and persons into whose possession this communication comes should inform themselves about and observe any such restrictions. ESLJ is a company of Intesa Sanpaolo SPA,